All right. I'm sorry, uh, I only have got 15 minutes recording time for each video, so my videos are cut midway and so forth. I'm sorry for that, but I hope you guys gonna understand. Now, going further on the features of organization, we say that different people do different things, or specialization is encouraged. Uh, there's also a feature that they do pursue a variety of objectives and goals. All right. So you see that, for example, the Zimbabwe National Army is not only there to go to war. You see, sometimes the members of the army do some law enforcement in the country, or sometimes they do some, community work, like for example, building bridges or helping people to fight, helping the medical people to fight pandemics like COVID and so forth. They will be participating. Members of the army also do participate in evacuating people in floods or in other, these natural incidents. All right. So they do a lot of things. They have got a variety of objectives, not only one. Then lastly, most organizations obtain inputs, for example, materials, for example, manufacturing companies, and process them into outputs. All right. Like, for example, goods which could be bought by other people. All right. So those are the main features of organizations, but the list is not exhaustive. This list is not exhaustive. We might be having as many features as possible. So you need to be open-minded. For you to pass these examinations, you need to be open-minded. Are we together? Please smile. Please smile. Thank you. Now, why organizations exist and how they differ. Organizations enable efficiency, more from less, than individuals. Specialization, time savings through teamwork, knowledge sharing, and synergy. So you discover that a one-part business, for example, a sole proprietorship, is not likely to grow fast. Why? Because of lack of synergy. All right. We believe in business that synergy exists to enable the multiplication of output. So in synergy, we believe that 2 plus 3 is not equal to 5. No, but it's equal to 6 or more. Are we together? So 1 plus 1 is not equal to 2 in synergy, but it's equal to 3 or more. All right. So more people, that's multiplicity of results. That's more and more results. All right. Organizations differ in many ways, including ownership. We might be having some which are called, private or public limited companies, which are owned by many owners who are called shareholders. All right. Or we might be having a public entity, all right, or a government or a state-owned entity, right, which is owned by the government. All right. But all those are organizations. An example of a state-owned company is the NRZ, the National Railways of Zimbabwe. Right. It is an organization. Then the organization may differ in terms of control. Sometimes the organization is owned by the real owners or by agents. For example, companies are owned by agents. All right. What do we mean? They are controlled by agents. What do we mean? There are people who are called directors. All right. These ones are not real owners. They are not the actual owners of the company. but they control the day-to-day running of those companies. So we call them agents. They represent the person called the principal. Okay, directors are agents. They work for the principal, and this principal is called shareholder. So shareholders, because they do not have the time or sometimes the expertise to run the companies, they hire someone who is more qualified and they make him a director to oversee the day-to-day running of the company. So the directors are agents. Okay, good. But if the owner runs the business himself, that might be what is called a sole trader, right? Or a sole proprietorship, something like that. Businesses may differ in terms of activity, what they actually do. Some are manufacturers, some are there to ensure that they offer services. For example, a telecom company, they don't manufacture anything, but they do offer internet services or a core service, all those things. Some might be profit making, whilst others might be non-profit making. They might differ in terms of the legal status, whether they are limited or, whether they have got a limited liability or unlimited. All right. Limited liability simply means that the liability of the company in the event that they go bankrupt is limited. The owners of the company are not going to be punished for anything outside what they were required to contribute in forming the company. All right, because their liability is limited, and this is common in private companies or private. What can I say? Um, those companies which were formed through incorporation. If you register a company, you are running away from the liability in case when you go bankrupt. So through incorporation under the Companies Act and other business entities in Zimbabwe, we have got what is called the COBE. But normally the name of this act is similar. There is a company something. Okay, usually it's a Companies Act. All right, but in different jurisdictions they might spice it up to look different, something like that. For example, in Zimbabwe, it is now called the Companies and Other Business Entities Act. All right, but the principles are the same. Uh, Limited liability simply means that the owners are protected to some extent because of the incorporation of the company. In an unlimited situation, it means that the owners are going to be sued as well as the business itself, which means the owners are not covered. Their liability is unlimited. Okay, they might be punished together with their business, something like that. Then the business organizations could also differ in terms of their size. Some are small, some are large. Then the sources of finance. Some are financed by debt or loans, whilst others are financed only by equity or owner's capital, owner's funds. Then technology in operations. Some are manual intensive or labor intensive, whereas others use more technology. You understand? And these days, even in technology, there are others who are more advanced, and with the advent of artificial intelligence, some businesses are more sophisticated. Artificial intelligence, machine learning, robotics, etc. Those are taking the industry by storm, which means by the end of the day, the use of humans is going to be very, very limited. Although that assertion is still very, very debatable. Okay, uh, let's proceed. Types of business organizations. We have got what are called commercial organizations. These ones, they are there to make profit. So the idea there is to maximize shareholder wealth. Okay, and businesses in this category, we have got the sole trader, those guys who are trading on their own. We've got partnerships, we've got limited liability companies, and so forth. They are there to make profit. Commercial organizations are usually uh, classified as uh, primary sector organizations who deal in the extraction and production of raw materials. Okay, the commercial organizations could be found in the primary sector as well, where they do extract, for example, in mining and so forth, or produce uh, raw materials. For example, cotton. Okay, they produce cotton or they produce grains in the agricultural sector. So that's a primary sector, right? They produce raw materials. Then the secondary sector, that's the manufacturing. These guys, they beneficiate, they add value to the raw material. They convert raw materials into something unique. Okay, a motor vehicle or into a cell phone and so forth. So they are a secondary sector. Please, in the examination, uh, mind these terms. Okay, do not forget them because they are rich exam grounds. So if you just read them like a storybook without casting them in your heart, you're going to be in trouble. All right. Now, the tertiary sector. This is there to provide, for the provision of sales and services, like for example, insurance, financial services, etc. Those they do sell services. All right. Sometimes a quaternary sector, the quaternary, the quaternary sector is split out from the tertiary, where we look at research and innovation, research and development industries, such as IT and pharmaceutical research. Those are the quaternary sector. Okay. Uh, we also have what is called the not-for-profit organization. Okay, an example of a not-for-profit organization could be a charity, such as a charitable hospital or an NGO. Instead of producing a profit and loss account, they tend to produce an income and expenditure account. Ultimately, their income has to exceed or match the expenditure or they will run out of money. So usually they just do what is called cost recovery, all right, where they simply, sometimes they charge below market value just to recover costs. All right. For example, if you go to a charitable, hospital, instead of paying $5 for you to get consultation, they might charge you $1 for a card and so forth, and then you get free consultation. Now, public sector organizations. These ones are owned by the state, either at a national level or at a local level. For example, hospitals or municipalities. For example, private sector organizations are organizations not owned by the state or local government and include both private and uh, public limited companies. So this could be essential, but in terms of placement there, it might confuse you. But we are simply saying that uh, public sector organizations could be found at national level, right? For example, if you look at the the Zoom Post, for example, the Zoom Post is a public sector organization, right? It operates nationally. However, if we look at a district hospital, for example, Parenya Hospital, it's a provincial hospital, or even, to some extent, it's a national hospital, but it could be a provincial, serving Harare province and so forth, but it can as well attend national. All right. Now, all those are public sector organizations. Why? Because they are owned by the state. A hospital could also be owned by the local authority, but that doesn't remove it from being a public sector organization. The idea is that the owners are public owners, or are the state is involved, or maybe the organization that owns that or that superintends that particular establishment is an organization directly owned by the state. So by the end of the day, it becomes a public organization. For example, a hospital owned by a municipality is technically a state enterprise, although the state has delegated the local authority to superintend its activities. Right? Non-governmental organizations. These ones tend to be not-for-profit organizations, but with an international brief. Many United Nations organizations will fall into this category. Okay, those NGOs like UNDP or like World Vision and so forth, they they tend to have some international exposure or I mean presence, something like that. Then we have got cooperatives. Cooperatives are owned by people who work in the organization. Please bear this in mind. Some farmers, for example, set up cooperatives to market their product more effectively than they could do on their own. Remember, we said that organizations have got some synergy benefits. So if farmers group together and form an organization or a cooperative, they are highly likely to succeed than if they do it individually. Usually they seek some sort of profit, but the ownership is shared widely amongst the people who are working in the organization. So usually these differentiate cooperatives from partnerships, right? Because in partnerships, some partners might not be working in the organization, but in cooperatives, they will be working in the organization. Please bear that in mind. Now, we come to stakeholder goals and objectives. What is a stakeholder? A stakeholder is any person or institution in any way affected by the organization. The three groups of stakeholders are, so we are saying any person affected by what an organization is doing is a stakeholder. Okay, so we've got three groups. The three groups, we've got internal stakeholders. These ones are those guys who are definitely inside the organization. A good example would be employees and managers. These are internal stakeholders. Then there are other guys who are called connected. Please bear in mind, shareholders are not internal. They are not internal stakeholders. Okay? Please bear in mind. In the examination or in exam questions, shareholders usually confuse students. They usually take them for internal stakeholders. They are not. They are not. Are we together? Good. Connected stakeholders. These are those guys outside the organization but are connected by way of a contract of some sort. Good examples here will be suppliers. Our suppliers for raw materials or for goods for resale, like wholesalers, they are stakeholders who are just connected by way of contract or some sort. Customers are also connected to us. So they are connected stakeholders, but they are not internal. The shareholders are connected to us as connected stakeholders. Okay, so this is where they belong. They are connected stakeholders. Although their name, stakeholder, shareholder, usually confuse people, uh, they are connected stakeholders. They are not internal. Then there is lenders or funders or bankers, people who give us loans. Those ones, they are connected stakeholders. Then, lastly, external stakeholders. These are entirely outside the organization with no contractual relationship. A good example for this will be the people living nearby a factory. They are obviously affected, but have very limited contractual rights over what the factory does. The government is also an external stakeholder. So the people living nearby, near your premises, they are external stakeholders. The government is also an external stakeholder. While studying about stakeholders, we need to be able to deal with the interests of various stakeholders. But first of all, we need to know how to manage the most critical relationship of the business and stakeholders, that is the agents relationship. This is a very pertinent relationship. Like I said, when shareholders form a company, they normally don't run that company, but they hire somebody called an agent. An agent, when hired, he has a mandate to ensure that he satisfies the interest of his principal. But in most situations, this is not always the case. The agents tend up, I mean, tend to, pursue their own ulterior motives. They tend to be clogged in self-interest and pursuing various agendas. So the agent's relationship has to be there, has to be monitored to ensure that by the end of the day, the shareholders, who are the owners of the company, are satisfied, as well as the agents themselves are motivated to continue working for these principles. For example, shareholders might ensure that companies, these directors, are given performance-related pay. They are also given good perks to continue to be within the companies. Otherwise, if shareholders are too stingy, the directors would not be forced to stay. They will pack their bags and go elsewhere where there are greener pastures. So it's a win-win situation. We need to ensure that we do something that tempts these directors to stay, but at the same time, to put them to account. So there should be some mechanisms in place to ensure that what the directors do is not in conflict with the expectations of the shareholder. Are we together? We need to give them good bonuses, okay, like first class air travel, board meetings in exotic or pleasant locations like in Lake Kariba or in Victoria Falls. Remember, Victoria Falls is a tourist attraction, and your directors should, at one time in a particular year, go there for a meeting that will motivate them to remain loyal to you. So you need to make them happy. They will in return make you happy. So that's the situation we are talking about. However, there is an important framework we will discuss about. All right, there is an important framework, that is the Mendeley matrix. This one is a very, very important framework in mapping stakeholder interests and their influence. All right, so it is actually a stakeholder management tool Here, we are looking at the stakeholders' power vis-a-vis interest. All right. So if you look at the diagram shown on the screen, there are two axes. There is this particular axis, okay, the x-axis that talks of the level of interest. We are moving from low to high, okay? We are moving that direction. But if you look at the vertical axis, there is the power, all right? When we talk of power, this is the ability to, to cause an action, the ability to cause an action in somebody, or the ability to influence their response or their action. Then when we talk of interest, we are looking at, the willingness, your willingness to complain, willingness to cause an action. So sometimes you might be having a willingness to cause a company next to you to do something, but without power. If you don't have power or influence, then they're not going to listen to you. So if you look at the diagram there are four quadrants, right? We are having quadrant A. Quadrant A, there is low power, there is also low interest. Okay, if you look at from here, that's where we see that there is low, right? And here again there is also low. So in this quadrant, they are both lows. There is low power, there is also low interest. All right. Then in B here, we can see that in terms of interest, okay, in terms of interest is high, but there is also low power. How do we do with that situation? Then if we come to C, there is a high power, okay, there is high power, but the interest is low. All right. Then there is quadrant D, that one, there is high power, high interest. Okay, high power, high interest. This is a major stakeholder. This stakeholder is serious. He is called a key player. Key players are found in segment D. Strategy must be acceptable to them. So which means your corporate strategy should be acceptable to them. If they are not happy with your strategy, you are in trouble. All right? An example would be a major customer, right? A major customer of the business. If they are not happy, you are out of business, right? These stakeholders may even participate in decision making. So if you are looking, for example, at a university, there is what is called a student council, a student representative council. If those guys are not happy, they are going to cause problems to your university. They will influence all the students, and by the end of the day, you will have student turnover that is very, very serious. They will leave your university, and you are going to be in a deep hell of problem. So you need to make them happy. If you are a wholesaler, there is a particular retailer who comes to you and who does a lot of orders with you. If that customer is unhappy, you're going to be in trouble. So that's a key player. Then stakeholders in segment C. We said C, this is C. In C, there is high power, okay, high power, but the interest is low. Okay, in terms of interest, the interest is low, but there is high power. Okay, while often passive, they are capable of moving to segment D. These guys from C, they are dangerous. Even if they don't have much interest in pursuing or in complaining, they have got more power. All right? They are capable of changing their minds and move to quadrant D. They should therefore be kept informed. You need to keep them, they should be kept satisfied. they should always be satisfied. Large institutional shareholders might fall into segment C. Usually shareholders, they remain quiet, but they've got the power if they are institutional shareholders. Institutional shareholders are those shareholders which are in themselves companies. They are not individual. For example, if we look at a company like, for example, a commercial bank could be owned by the government. The government is an institutional shareholder. It's an institution, right? Or another company, like for example, another company like a manufacturing company could as well have shares in a bank, in a commercial bank. So those shareholders have got more power. They've got all the resources to pursue a matter. They can take you to the high court. They have the money. They can do anything. So you need to keep them satisfied with whatever you are doing, such that they might not develop their interest into quadrant D. Please pay careful attention. Then, stakeholders in segment B. These ones have got high interest in terms of the level of interest. In terms of the level of interest is high, but they've got low power. Hanzi vanoda zvino. But Sibavana, they have got more interest. They are willing to do something. But in terms of power, they don't have the power. Okay? They have no power, but they've got high interest. So, the segment B stakeholders do not have great ability to influence strategy, but their views can be important in influencing more powerful stakeholders, perhaps by lobbying. They should therefore be kept informed. Please be careful with this. They should be kept informed. They have got high interest, but no power, so keep them informed. Community representatives and charities might fall into segment B. All right? They have no power, but they can influence something. All right? They have got high interest in whatever you are doing. Community elders, all right? They or even the NGOs or charities in your area, although they do not have power, they might influence something that might harm you. So you need to respect them. Keep them informed. We are doing this. Please appreciate what we are doing. We are moving this way, and we hope that by the end of the year we'll be doing this. That will make the environment good. Something like that. You need to keep them informed. Lastly, we have got the guys in quadrant A or the segment A. These ones have low interest, have low power. Low interest, low power. All right? You just have to give some minimal effort. All right? Give them some minimal effort. Don't just take them for trash, but just give them, some minimal effort as a way of managing them. Right? As a way of managing them. Companies should exercise what is called corporate citizenship. Corporate citizenship. A company should be like a good corporate citizen. All right? So you do not take those people without power, without interest as nobodies. You need to treat them right by the end of the day. So remember, the framework is saying that you need to give them minimal effort. Simply means that you must not ignore them. Just give them minimal effort. So there is no way this model is saying that other stakeholders are less important and so forth. But it's simply saying that you need to know how to manage different levels of stakeholders. The business environment. What are the the chapter learning objectives? By the end of this chapter, you need to be able to use the PEST or PESTEL framework to understand or evaluate the business environment. You need to identify a business strength, weaknesses, opportunities, and threats. So that's the SWOT in a market and the main sources of competitive advantage. Identify the main elements within which the porter's value chain uh, is utilized. Explain the meaning of a value network. Explain the factors or forces that influence the level of competitiveness in an industry or sector using Porter's five forces model. Isn't it an interesting lecture? Good. You need to find some glass of water and you need to quench your thirst, otherwise you run dry and faint. Okay, so you can just pause the video, take your snacks, and then continue with me. Thank you. Okay, so let's proceed. Now, environmental influences. Excuse me. The PESTEL. The PESTEL model looks at environmental influences which are very large and powerful. That's the macroeconomic environment. Or let me just say the macro environment. Because we are not only looking at economic issues alone, but even social, political, and so forth. So that's the macro environment. It stands for political, economical, social, technological, and relatively recently, ecological. The I and I mean ecological and legal. All right, this is just a typo. All right, ecological and legal. It's easy to see how this will influence how a business gets on. For example, political. Zimbabwe joining or leaving the AU or SADC. Political tangents, war, alliances, and change of government can all influence many businesses. If you look at the impact of the the exit of the UK from the EU, that caused some uncertainty in terms of business environment in the UK or outside the UK in those days. So, those political spheres have got an impact on how businesses are going to perform. For economic, it goes without saying that economic changes can have very serious influences on business and anti-economic will come effects such as interest rates, exchange rates, tax rates, and whether the world economy seems to be doing well or is in decline. This also applies to other factors of the PESTEL framework like social, technological, ecological, and legal. Okay, now let me just talk a bit about social. All right, when we talk of social, we are looking at things to do with you know uh, social trends, fashion, tests. Sometimes, for example, if you're a clothing store, right, uh, you need to look at what your environment or your potential customer is. Are they an aged population or they are youngsters? The youthful population and so forth. What do they like and what is trendy in those days and so forth. In terms of tests, are those people fashionable? Are they old fashioned and what do they prefer, what do they like most, right? Stuff like that, because people's tastes change over time. Sometimes what was good in the 1990s is no longer good currently. So you need to be able to understand those aspects. Then technological, we are looking at the use of ICT in the economy, and whether the product you are selling or the type of your business is expected to be techno savvy business or something that has to be traditional. You need to look at those things, right? Then the adoption of technology itself around your community or your country, in your country, what is the technological acceptance rate and so forth, or adoption. Then ecological, we are looking at things to do with the environment. Uh, that is, things linked to climate, things linked to the natural environment, right? Issues to do with forestation or deforestation, issues to do with the impact of mining practices and so forth. Aquatics, I mean, all environmental degradations and so forth. Those things are catered for under the ecological influences or factors. Then the legal framework in your country, do they respect property rights, human rights, etc. All those impact how businesses perform. Competitive forces. Having considered the macroeconomic environment using Pastel, we can zoom in and consider matters relating to specific industry sectors. There is what is called Porter's five forces model, all right, which is useful in analyzing industry sectors and industry attractiveness. Industry attractiveness refers to how easy a business will find it to make reasonable profits. By reasonable profit, we mean profits large enough to compensate investors for their risk and also to make enough money to invest to keep the company successful. The competitive environment is structured by five forces, namely barriers to entry, existence of substitute products, the bargaining power of customers. How powerful are your customers? All right. When we are talking of barriers to entry, we are simply saying that is it easy to, I mean, how hard is it to enter a particular market? Then substitutes. Substitutes are those products which can be used instead of a particular product. So they are substitute. Instead of using instead of having lunch with sadza or maybe thick porridge, we might prefer to go for potato. Okay, potatoes and beef instead of sadza and beef, something like that. Okay, they become a substitute. All right. Then the bargaining power of customers, we are referring to, I mean, the influence your powers have, I mean, your customers have over what you sell or over your business. Remember, when we talked of stakeholder management, we pinpointed that there are customers who are called key players. So, how many are they? If the key players, I mean, if the key customers or main customers are few, then it means that they are powerful. Customers are powerful when they are few. But if you see that you have got a lot of options, there are so many customers around you, then their bargaining power becomes low. All right, so they are powerful if they are few. All right, similarly, the bargaining power of suppliers is also high if the suppliers are few. For example, if we look at the electricity market, the hydroelectricity market, you can see that there are maybe monopolies. Why? Because the suppliers of such services or such products are few in an economy. So this is why they do whatever they want. They do not have competitors. So if you are a monopoly, you just do whatever you wish unless the government stands up and says no, toe the line. Otherwise, you're going to be sacked. Then that's when they then start to do those communications or feedbacks to the community saying that no, our grid has got a problem, this and that, whatever they are saying. At least if they say something, that should be a show of sincerity. Then, competitive rival. How competitive is the market? How many competitors are there? Are you gonna able to stand the competition? So if the competitive rival is very low, then you might as well find your stand. But if it is an industry where there is stiff competition, then you better look elsewhere. So that's the five forces model, ladies and gentlemen. For you, excuse me, we have discussed about this, right? Uh, where we are saying that we have got potential entrants. The potential entrants are the newcomers, right? So they face what are called threats of entry or the barriers of entry, right? And the customers, their bargaining power matter. Their bargaining power matters, right? So if they are few, they will be very powerful. However, if there are so many customers in a particular industry, then uh, they might not be as uh, anything to worry about. Okay, then substitutes, the threat of substitutes. If your product has got a lot of substitutes, you are going to be deep hell of a problem. You're going to be in a deep hell of a problem, right? Then suppliers, if they are many, then you're likely as well going to find it very, very difficult to find your standing, So that's the idea behind the five forces model. Then there is what is called Porter's value chain. Porter's value chain is used to examine how a business makes profit or margin. Right. So when we talk of the margin or profit, we are looking at this the red. Uh, this is the margin, ladies and gentlemen. We are talking about the red area here. So whatever we are going to do as a firm, we must have the margin in mind. We must have the profit motive. So be it you are in the sales department or you are a cashier or you are a till operator, by the end of the day, you need to think of profit, whatever you are going to do. So when you want to delay coming to work, like you want to report for work late, you need to think of profit. Is that going to make your company profitable? Think about that. All right, so that's the idea of Porter's value chain. Everybody matter within a firm. So there are two activities. There is what are called support or secondary activities and primary activities. So primary activities are those ones which are mandatory. We want to expect. Those ones are expected. We want to see them if there is a business organization to talk about. So the primary activities are five. There are five primary activities. Five. Okay. Number one, there is what is called the inbound logistics. This one this one talks of how materials are going to be secured or are going to be procured into the business. How are we going to get the materials? Those are the inbound logistics. So it involves the transport that ferries those materials, the suppliers, those guys who are going to give us those raw materials or inputs to the business and the means of delivering them. All right, for example, if we are going to find our raw materials from China, how are we going to ensure that they arrive in time? What logistics are in place to ensure that those raw materials are going to be delivered in time and in rightful quantities? Quality considerations are also going to be of importance. Then, number two, we have got what are called operations. Operations are the means to convert the raw materials into finished goods. How efficient are we? Do we have all the technology required to ensure that our processes are as efficient, economic, and value adding? Outbound logistics, these ones talk of the distribution, the sales, the distribution logistics available to ensure that our customers receive the goods when they need them in rightful quantities and within the agreed time frames. Marketing and sales. This one has to do with our effort to ensure that our products reach the market in time and as economic as possible. We need to ensure that our customers meet the product, see the product. We need to ensure that our presence is so significant that we are not going to lose the market. We are not going to lose any potential customer. Then the service. The service here is normally called the after sales service. What service do we give after we sell our products? Are we going to support our customers in the installation or in the in making them able to use the product? For example, if you're a software company, you are selling an accounting software, you need to ensure that you install the software at your client, you train their staff to be able to use the software. That's an after sales service. This will ensure that your customers remain loyal to you. They'll always worship you. They're not going to run away from you for a long time. Are we together, ladies and gentlemen? Good. Now let's go to what are called support or secondary services. So in an examination, the examiner might say, which ones of the following are secondary activities? When you are only used to the term support activities, you're going to be thrown overboard. So get used to both terms, support or secondary activities. So we have got what is called the firm infrastructure. What is firm infrastructure? When we are looking at the firm infrastructure, we are looking at the organogram, okay, or the organizational structure. Is it a tall organization? Is it a flat organization? Is it a centralized organization? Is it a decentralized organization? What type of the firm are we? Is it traditional? Is it modern? All those things talks of the firm infrastructure, even the corporate culture itself. It has got a bearing. Even if we have got all these primary activities at core, we might see ourselves failing to deliver if we do not have an appropriate corporate infrastructure. Issues to do with leadership. Okay, how the firm is led, the type of leadership in place, the culture, the systems in place, the strategy that has been adopted. All those are accounted for in the firm infrastructure. Then, when we talk of technology development, this is self-explanatory. What type of technologies are being utilized and are in place, right? Okay, so basically in technology development, We are also looking at issues to do with R&D, okay, research and development, and the adoption of technology in general. Okay, our process is inclined towards what is called automation. All right, so whatever we are going to do, we should ensure that the automation or the research and development is triggering us towards the attainment of the profit margin. Shall we remain traditional, or we need to upgrade our processes technologically? That's the idea. Okay, we need to upgrade, we need to automate, we need to use sophisticated software to assist in our processes. So that's the technological development aspect. Then the human resource management, this one has to do with our hiring practices. Hiring practices. This one affects a lot of companies. Some people are just obsessed with certain qualifications such that they tend to ignore others, and they tend to sacrifice their companies just for the sake of hiring a particular qualification. That is a bearing. The way we manage our employees, do we motivate them, or are we motivating them? Or sometimes we're just, adopting a non-caring attitude. Are we serious of retaining skilled workforce, or we are just box ticking these things? So all those have got a bearing on how the entity is going to proceed going forward, right? Do we train our employees? Are we developing them? So training and development matters as well. Are we also assessing their performance? By the end of the day, there is also what is called performance management. Although there is a module dedicated for this in ACCA, you need to as well appreciate that it is part of the human resources management. Then we also need to talk of compensation and benefits. Compensation and benefits. Are we paying our employees well? How are we paying them? Or we are just treating them like animals? Are we serious of keeping the labor force? All right, so that's the aspect when Porter was talking about the human resources component. All right, then finally, procurement. Procurement. This one is a very essential aspect. It's a very, 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 very essential aspect. How do we select our vendors? Okay, talk of vendor selection. How is the bidding process taking place? How do we purchase raw materials? Which platforms are we using? Who are the parties to our supply chain management? Right? How do we manage supplier relationships? How are we managing them? All right? All those things. Which areas, which locations are we procuring our raw materials? Who are they? All those things will lead to the creation of margin. Sometimes if you procure our raw materials from wrong places, places who do not, which do not value human rights, who use child labor, by the end of the day, our customers are going to be annoyed, and they will leave us and go for those uh, companies who are observing sustainable business laws. So we need to be very, very serious with all these. The procurement of raw materials, how is it structured? Is it following ethical business practices or not? Then basically, just as a revision, firm infrastructure talks of the way, of the organizational structure of companies. I've spoken about that. Also talks of strategy, the strategic planning process. Okay, strategic planning process. It also talks of our finance and accounting practices, right? The legal and compliance issues are also touched in this. Then the management of organizational processes in general. are also covered under the firm infrastructure, right? Now, the margin, like I said, is the excess the consumer is prepared to pay over the cost the cost to the firm of doing all those processes. So that excess a customer is willing to pay, all right, to obtain uh, whatever value from the ended activities. So it represents the value created by the value activities themselves and by the management of the linkages between them. Right? So that excess a customer is prepared to pay over the cost to the firm of obtaining resource inputs and providing value activities. That's the margin for you. I'm sure we have done almost everything. Do we still have anything here? Okay, the value network. Each organization has its own value chain, but what customers buy is usually the end result of the effort of many organizations: raw material producers, component manufacturers, logistics companies, assembly, and retail distribution itself. Each organization should be contributing to the value of the final product, and the whole set of organizations is called a value network. The following pictorial is relevant. So that's the value network for you. We have got supplier value chains, organizations value chain, distributor, retailer value chain, customer value chain. So all these organizations have got their own value chain. But by the end of the day, if your organization happens to be part or to be part of this network, it has to ensure that it also does something that adds value to the network. This is why I say that sometimes when your procurements are not being done ethically, or or the geographical locations from which you obtain your materials are not considered to be observing certain ethical practices, then you are going to have a bad goodwill in terms of value creation or value network. All right, so you need to observe, to observe, to participate in the value network with the idea of adding value to it and not disrupting it. All right, so each organization should be contributing to the value of the final product, and the whole set of organizations is called a value network. All right, now let's talk of the SWOT analysis. Okay, SWOT analysis, a method of environmental analysis which looks at an organization's internal strengths and weaknesses, as well as external opportunities and threats, is known as SWOT analysis. An internal appraiser will identify the areas of the organization that have strength that should be exploited by suitable strategies. So we look at our organization and ask ourselves, what are we good at? How can we exploit, how can we benefit from that particular strength? What strategies shall we adopt to ensure that we benefit from what we have, at the moment? Then B, the areas of the organization that have weaknesses, which need strategies to improve them, right? So we then ask ourselves again, where are we weak? What should be done to improve those areas? The strength and weaknesses analysis is intended to shape the organization's approach to the external world. For instance, the identification of shortcomings in a product could lead to a program of product development. The external appraiser identifies opportunities that can be exploited by the organization's strength and also to anticipate environmental threats against which the company must protect itself. Opportunities. What opportunities exist in the business environment? What is their inherent profit making potential? Can the organization exploit the worthwhile opportunities? What is the comparative capability profile of competitors? What is the company's comparative performance potential in this field of opportunity? Threats. What threats might arise to the company or its business environment? How will competitors be affected? How will the company be affected? So those are the questions which you need to answer. And when you get those solutions, you will be doing yourself a favor in understanding whether these ones are opportunities and how to capitalize on those opportunities, and then what threats you need to then prepare for. All right, so that's the SWOT analysis for you. You need to ask those questions, get the answers, and you'll be ready to go. Using the SWOT analysis. The SWOT analysis can be used in one of two ways. Number one, the organization can develop resource-based strategies which enable the organization to extend the use of its strength. This is common in retailing. For example, a supermarket chain extends their own brands from food to other areas. Two, the business can develop positioning-based strategies. In other words, identifying what opportunities are available and what the firm has to do to exploit those opportunities. Ladies and gentlemen, before I call it quit, please let me just give you an overview of the entire syllabus. All right, so hang on in the next video for the overview of the syllabus.